The focus is the process. There's a better way to do money, to run money through this system before you do debts, before you buy your next car, before you do your investment.
So we changed one thing. Instead of flowing our money through somebody else's bank, we flow our money through our own banking system. I mean, imagine paying off debt quicker than otherwise possible while still building wealth and creating a legacy for your family. Hey, what's up, everyone? Welcome to Wealth Webinar. My name's Stephen Nagy. I'll be hosting the show today on behalf of Chris Naugle, along with Mr. Craig Yenny, and we are going to be talking today about becoming your own bank and the infinite banking concept. But we're not going to do, the standard presentation you might have seen. We're going to get down into some nitty-gritty weeds of this thing, and Craig's put together some really cool little case studies and examples, and I think it's really going to connect with a lot of you. So if you're brand new to Wealth Webinar, our campfire, we do this show every single Wednesday. We do 5 other webinars throughout the week, completely free of charge. We're constantly putting out content on social media and YouTube. So go check all that out. We're here to support and help you, but our entire mission in life is to show you how to take back control of your money and solve your money problem. So we're going to start diving into that today and showing you exactly what that looks like. With that being said, let me introduce you to Mr. Craig Yenny, who is the brains behind a lot of the BYOB tools, the BYOB vault. They call him a freak in the sheets because he's Mr. Spreadsheet Man and is very, very good at what he does, putting together complicated formulas and complicated different strategies, but making them very easy to understand through technology. So Craig, thanks for being here. Thanks for everything that you do to help people understand this and really prove the math behind a lot of what Chris and I talk about. We talk and we can show and things like that, but you prove it out with math, and it's really amazing. So I love having you here today, and I'm really looking forward to this. So what's up, man?
Hey, well, thanks for having me. And I always love being here and just doing some sort of teaching. And like Steven said, we're not going through the whole process today. We're kind of narrowing in on some specifics around infinite banking. All of the past wealth webinars are out there on Chris's YouTube channel. So if you want to go out there and watch those, that's available. And so what we're typically doing on these specific webinars, we're kind of picking out a topic that people ask us about a lot. Or if we hear from, different social media channels, hey, these are the things that I'm kind of wondering about. And that's going to also be a plug. If you're not part of our Facebook group, it's the Infinite Banking Facebook group that the BYOB team runs. Feel free to go out there, join it, give us some feedback and things that you might want to see in a future wealth webinar, because we're always wanting to tailor content to you, for you, and help you understand this process a little bit better. So today, what we're going to be talking about is really focused in on monthly premiums into our own banking system. But before we get there, let me just ask a quick question of everyone out there. If you're new, this is your first wealth webinar, or you haven't been here in a really, really long time, can you just put I in the chat? I just want to see how many folks do we have here for the first time. And it always is very impressive, Stephen, just to see every week how many new folks are joining us. Wow. Yeah. Welcome, everybody. That is really phenomenal. Okay.
Very cool. I mean, we see so many of the same names on the chat every week, and we love everyone that comes back week after week, but it's great to see some of the new people. Jeff Ervik, your name looks familiar, but you said it's been a while, but I always remember the names. But wow, Craig, very cool. So we're gonna have to maybe set this up and then we'll get into some of this, right?
Yeah. So I don't know, Stephen, do you want to give just a quick plug on what infinite banking, what's the real benefit? Why are we doing this? Because once we kind of set that table, then I'll go ahead and jump into some of the details of the presentation today. And that way, at least for all the folks that are new, they'll just get kind of a general sense of what we're talking about. What is BYOB? What is infinite banking?
Yeah, absolutely, Craig. And so what we do is it's nothing that we've created. It's nothing that we, came up with. This is a strategy that's been around for over 200 years, used by some of the wealthiest families in America, politicians. And ever since really the late 80s and 90s when Nelson Nash introduced the infinite banking concept to the world through his book Becoming Your Own Banker. It's now been used by everyday people that just happen to run across the information and knowledge. Maybe somebody shared it with you. I say the story all the time. I was a financial advisor back in 2006, 2007 with Ameriprise Financial, right out of college, and, learn the traditional side of life insurance and traditional side of investing and 401ks and the rest of it. I think then that led me into the world of real estate investing and entrepreneurship. And, I've been in that ever since, but I didn't actually know about or learn about infinite banking until 2019. And it didn't really connect with me until 2020. So even though I was in the financial education and financial world for 15 years, I had still not even known about it myself. So it's what I like to say one of the best kept secrets out there, but it's something that everybody needs to know about because, it can solve so many different problems for so many different people in so many different walks of life. And
Mhm.
Craig, today we're going to talk a little bit about debt and how to fund these policies and what that looks like. But basically, if you're sitting here right now, and you guys can tell me, I'm just curious like, who's on. So if you guys don't mind participating in the chat for just a minute, if you're somebody that has some debt, credit card debt, maybe high interest debt, even student loan debt, things like that, if you have any debt, just put debt in the chat box. I want to see if there's any debt on here. If there's somebody that maybe you're approaching retirement age or really thinking about retirement, how you can make sure to retire, the way that you want to, and you're kind of worried about the stock market right now, you're worried about the economy coming up, you want to control your money, just write retirement and if you're multiple of these, that's fine, but write retirement in there, and that's something that we do. And now the last one I'll ask is if you're somebody that maybe you're a little more advanced with your finances already, you own a business, you're a real estate investor, you're already out there making moves, doing some things. Maybe you're a private money lender. Just write investor. Even if you're a business owner, write investor in the chat. And because what we can do with this concept that Craig mentioned, the infinite banking concept. So just to make this very simple, and you saw this on the intro video with Chris, all we're doing is changing one thing with the infinite banking concept, and that's where your money goes first. So very simply put, what most people do is they earn their money from a paycheck. They get paid, however they earn money, and they use that money to pay off all the bills. They pay off expenses in their life, they live their lives, and then whatever is left over at the end of each month usually ends up going into savings. Well, what we do with the infinite banking concept is we take our money and we try to flow that money instead of through somebody else's bank account, like a Wells Fargo, a Chase Bank, Bank of America, something like that, like most people do with their paychecks. What we do is we take that money and we flow it through our own banking system. That's why we see everywhere BYOB. It stands for becoming your own bank or becoming your own banker. So we change one thing. Instead of flowing our money through somebody else's bank account, we flow our money through our own banking system. And then from there, that allows us to, instead of paying all the bills and expenses in life first, that allows us to start saving right from the very beginning. Because from there, every dollar that goes into this banking system, every dollar that goes in now is going to sit in there and compound and grow uninterrupted, guaranteed, tax-free for the rest of our lives. And simultaneously using this banking system, we can take that money out of there while it's doing that and use it to, pay off debt. Use it to make purchases like vehicles. That's why you hear us say things like, learn how to get every dollar back for every car you'll ever buy, drive, and own. Me personally, I'm taking that money, I'm putting it into businesses, I'm putting it into real estate investments, I'm putting it into private money loans. But the bottom line is I'm flowing it through my banking system first, right, Craig?
Yep,
So by making
absolutely.
that one change where the money goes first, it allows all the magic to happen. Now, to do this, we use the only vehicle that it gives us guaranteed tax-free compounding growth and allows us to simultaneously do the rest of it at the same time, which is a whole life insurance policy. So the vehicle we use to create this banking system is a specially designed and engineered whole life insurance policy from a mutually owned insurance company. And at the end of the day, essentially, that's what we do here at the BYOB Money School, is we are an insurance agency. We're licensed agents that are able to do this for you. This is why we can give so much free value, free education. We do calls, strategy calls. We're talking to clients. Our team, our money mentors are talking to clients all day, every day, and we never charge a dime for any of it. But we use a whole life insurance policy because it's the only vehicle that allows us to do all of that I just mentioned. That's the only reason, just so people know. But it is very important that you work with the right people, the right insurance carriers. It's designed the proper way and they know what they're doing. And not just designing a policy, it's not just a whole life policy. Remember, it's the process, it's the infinite banking concept. So it's how we flow our money into that insurance policy, but then how we move that money, how we manage that money, how we control that money that gives us the value and the power of what this does. And that's why we bring on thousands of clients every single year that learn about this. And it's mind blowing for them. It changes their entire way of thinking about money, finances in their life, interest that they bleed out, and everything else. So again, I will put a full 90-minute video of Chris teaching this in detail from the very beginning right through exactly what it looks like, and gives you examples of how to pay off debt quicker while still building wealth, how to recoup every dollar for every car you'll ever buy, drive, and own, and how to invest and make money, not just on your investment, but make money multiple times on the exact same dollar. So watch that 90-minute out of there. But that's the basics of it, Craig, is using the specially designed policy, making that one change, flowing the money through our banking system instead of somebody else's, and then allows us to do all of this that we're doing. Is that a pretty decent little setup there, 5-minute setup?
It does, and I appreciate you going through that. And I know there's a lot of questions that I see flowing through the chat as you were talking, and if you do have specific questions, if you can put those in the Q&A, that'll be a little bit easier for Stephen and I to be able to address those.
Yeah, the
But we'll
chat
get
box is
you.
moving pretty quick with questions or with
Yeah.
like responses and things. So if
Yeah.
you guys do have questions, we'll be presenting a second. I'll be answering all of those in the Q&A. If it's something that everyone should hear, we'll answer it live. Like, we are the most transparent, straightforward, honest people you'll ever meet. You can ask anybody that's been around for years, follow us in the chat box. We don't hide anything. We'll answer any questions all the time. So please put those in there, and this is gonna be a lot of fun today.
Yep. So ask the questions. We'll get you resources on how to book with our team. We'll get you resources on the video that Stephen was talking about. But for all of you that had mentioned you have some debt in your life, stick around because we're going to be covering that towards the end of what I'm going to cover. So stick around because you're going to see a new way to do debts. So here's what it's named: flexible premium and loan options for financial success. Now, as we go through this, there is a disclaimer here because we're making assumptions on a certain person with a certain age and health, and I'll show you all of those details. And as we go through this, just know that your numbers might be more or less than what I'm presenting. Your situation might be a little different, but Stephen was talking earlier about the focus is the process. So if you walk away with nothing else today, just what I hope that you understand is there's a better way to do money, to run money through this system before you do debts, before you buy your next car, before you do your investment. So all of those things are what we're really going to be talking about here. Now, for those of you that are in our Infinite Banking Facebook group, you may have seen, I think it was earlier last week, I asked a question. For all of you that have infinite banking policies, do you make your premium deposits every year? Do you do it on a monthly basis? Do you do it quarterly, semi-annual? And got some good feedback. And what I found is, of the folks that answered, most of them have annual, but there's a good portion that have monthly. So I'm just curious for the folks on here. I see David's got monthly, Jeff monthly and annual. So there could be a mixture, like what Jeff is saying. I might have some policies I'm doing monthly, some I might be doing annually. Tiffany's annual, Lennis all monthly. So we have a mixture of people, but what I really want to narrow in on this discussion is, and Stephen, I don't know if you get the same question, is it better to do annual? Is it better to do monthly? Is it better to do quarterly? What's the best thing to do? And what my answer always is, it depends. And everybody that's commenting in the chats, there's probably a reason you do it monthly or you do it annually. There's some reason behind why that works and how the money flows in your specific system. So I'm going to walk you through some of the differences of what annual looks like, what does quarterly look like, what's semi-annual look like, what's monthly look like. And at the end of the day, we're going to get into a use case using a monthly policy so you can really see the benefit of setting up the policy. All right. A lot of you may not care, but I want to always be as transparent as I can with what we're showing in the policy design. So in today's use case, we have this fella, I call him Bucky Doe, fictitious person, but he's 45 years old. He gets a standard rating. Some folks out there are always showing illustrations, and you got to be really careful of the illustration salespeople out there where they're going to show you, a 25-year-old male that has super preferred non-tobacco, the best possible case you can possibly get. What we're typically doing is showing what most people can get. And so that's why we're picking standard ratings. Now there's some stuff in here that's insurance speak. I'm not going to go through all of that for you, but for those people watching that may be a little more technical, these are some of the things you might care about. What's important for the audience today is to know that for the first 7 years, because I want to keep this thing apples to apples, for the first 7 years, we're putting $6,000 of premium in years 1 through 7. And then after year 7, we're just going to do 1,500. And the reason I've set it up this way is so I can accurately compare annual, semi-annual, quarterly, and monthly together. All right. A lot of numbers here, so I'm just going to kind of draw out the main conclusion. But if you had a policy set up for this 45-year-old male, standard non-tobacco, where they're putting in $6,000 a year, what I want to do is just kind of show you what does the snapshot look at year 10. So at year 10, you would have put in a cumulative premium of $46,500. Now, in all of the illustrations, there's guaranteed sides and non-guaranteed side. Can anybody put in the chat, what is the non-guaranteed? What's the difference between the non-guaranteed and the guaranteed side? I know we've got some people out there that can answer this in a couple seconds, so let's see who can come up with the answer first. All right, Anna Scott comes in with a win. Dividends, absolutely correct. So we got a lot of people saying dividends. Dividends are not guaranteed. But Stephen, can you remind me of all the companies we work with? When's the last time they missed paying a dividend?
I don't believe they've ever missed paying a dividend.
And they've been in business for well over 100 and some years. Some companies 120, some 140, some 160.
100%.
Isn't that crazy? Does anyone else out there just find that phenomenal that whether it's Mass Mutual, Lafayette, One America, it doesn't matter. They're all mutual companies. They've consistently paid dividends through world wars, through the Great Depression, through the bank holiday in 1933. That blows me away. But that's why we have two different sides of the table. We have a guaranteed, which goes in the contract. There's a guaranteed growth rate. The non-guaranteed side is going to show the values with the dividend calculated in. So what I'm doing in my annual, I'm showing $46,500 was put in premiums up through year 10. The guaranteed cash value is $38,000. That death benefit's $84,000. The non-guaranteed is $53,587 with a death benefit of $108,000. Now, you don't have to write these numbers down, but what I want you to see as I go through semi-annual to quarter to monthly, guess what's going to happen to all these numbers? Does anyone know what's going to happen to the guaranteed and the non-guaranteed numbers as I go from annual to semi to quarterly to monthly? Are they going to go up or are they going to go down? And as I see you out there, you'll know this answer. Down, 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 up. So we've got some folks that think up and down. Let's take a look at it. So when I go to semi-annual, it means I'm putting in money twice a year. So when I put all the money in at the beginning of the year, it has more time to compound. And also the other element here is that the insurance companies typically tack on a little bit of fee for non-annual. So semi-annual will have a fee, quarterly will have a little bit higher fee, monthly will have a little bit higher fee. So what we're going to see is as we go from annual, these numbers are going to continue to go down. So everyone that said down, you get the gold star. So now at year 10 on a semi-annual, we're going to 53,131, a little bit less death benefit. And as we go to quarterly, we're now down at 52, a little bit less death benefit of 105. And then once we finally land at monthly, where we're putting in $500 a month, we're down at 52,234 and a death benefit of 105. Now, people will ask me, well, then Craig, isn't it better to do an annual premium because I have all my money in the policy right away? I have all the compounding going on. I pay less of a fee because there's a little bit of a fee on the monthly premium. But let's take a quick peek at this. These numbers are on a policy where we're putting in $500 a month. But if I do monthly, my cash value is 52,234. If I do annually, it's 50,587. And this is at the end of year 10. So isn't it true that the annual premiums have about $1,353 more of cash value at the end of year 10, and it has about $3,000 more of death benefit? So if I annualize that out, it's about $135 difference every year. So if we did a bigger policy, those numbers are obviously going to go up. So if I did 50,000 a year versus 500 or 6,000 a year, these numbers are going up. But let me ask you, if it worked better for you to do monthly because of your cash flow, isn't that the best for you? If you were able to do the annual payment and you could put it all in right away, wouldn't that be the best for you? So I struggle when people ask what's the best, because we want to understand what your cash flow is and how that money moves to your system. So any questions on that so far? Looks like there's a couple things in the chat. Stephen, I'll let you deal with the Q&A and stop me if we need to make a pause and talk.
Yeah, keep rolling. I'm answering as we go, and I'll save anything live, and I'll interrupt you when it's time.
So one of the things I really want to stress, and Linus is asking, can I switch from monthly to annual? Absolutely. So there's some companies that would only allow you to do that at the anniversary, but in most of the companies we work with, if you started on monthly and at some point you want to change to annual, you can do that. So you can change those modes back and forth. Now, one of the things I want to really highlight, and I hope everyone's listening to this, because when you're working with someone in the infinite banking or they're setting up a policy for you, I would like everybody to always ask the question, what is the minimum? Not that we want you to pay the minimum, but we want to know what that minimum is, because you'll see on this particular policy where we're putting in $500 a month, the minimum that you really, really need to commit to is this $146.74. That's what it's going to be for the first 7 years. You want this number to be really easy, like, I could do that, no problem. I can slam dunk that number. So this is the minimum, but we have an ideal. Ideally, we want to put in the 500 because that's where we're going to get the cash value growth. That's where we're really going to be able to fund our banking system. Why do I mention this? Life happens. Whoever has felt impacts from the economy, whether it's increased prices, groceries cost more, eggs cost more, anyone ever lost a job, everyone ever had an emergency where all of a sudden you have all these medical bills you weren't expecting to deal with, or a car breaks down. Hey, this is what happens. And so we want to make sure that we protect your banking system and you can continue to fund it. That's why I'm saying premium flexibility is important, and we want to always know what those minimums are, although our ideal funding is going to be at that 500. All right. So life happens. We understand it. It doesn't mean you can't, maybe for 1 month you go down to the 146 and then you catch back up. And so there's some flexibility in that. All right. Guess what else you have flexibility on? Policy loans. Let's say that you took a policy loan out because you bought your own car, or you took policy loans out to help you with debt pay downs. And I'm going to show you a use case of what that looks like. Now, I'm going to ask, before I go to the next step, if you take a policy loan from your policy, are you required to make certain payments at certain times? I'm just curious. Go ahead and answer. Linda says no. Jody thinks we do. So there's some folks out there that think we do. Some people say we don't. Okay. So when you take a policy loan from the insurance company, it's not structured. The reason it's not structured is they don't really care if you pay the policy loan back at any particular frequency. So they're not going to send you a bill. They're not going to ask you when you're paying it. The interest is usually paid at your policy anniversary if you want to. If you don't pay it, it goes on to the principal of the following year. And so guess what? Guess who's in control of that policy loan? You are. You're in control of when and how that gets paid back. And the reason that's important is because life happens. And I go back to, we have eggs cost more, bread costs more, people lose jobs, we have emergencies. So if we had taken a loan out for a car from our own policy and you don't make your car payment, are you going to repossess your own car? Probably not. All right. So I want to just walk you through a quick example of showing how loans in the right type of insurance company, and I'll explain this a little bit more in a few moments. Do loans impact cash value? Meaning, if I take a loan from my policy, is that going to hurt the growth of my policy? Okay, so a few people are saying no, you guys are on it. So here's what it looks like. I'm just going to pick a baseline. I just need some numbers to pull out. So this is the policy where we're putting in $500 a month. We've not taken any loans out, but the cash value at the end of year 10 is projected to be $52,234 and a death benefit of 105,000. Okay. Let's see, what does it look like? Let's say at the end of year 1, so going into year 2, I take the maximum loan I can take out of my policy. So I ended year 1 with a cash value of 4,562. I can take about 93% of that. So if you do the math, you'll see that it's about 93%. I can take $4,264 out as a loan. Now, somebody had asked earlier in the chat, and I don't think we've addressed it, but they said, doesn't it take a year or two before I can even use my money? In a traditional whole life design, if you walk down the street to someone that doesn't understand infinite banking and they set your policy up incorrectly, it may be 2, 3 years before you can access the money. What we're doing in the policy design is you will have access to some of your cash value within the first 30 days. So let's say you put in $10,000. Let's say you dump in 10,000, which is like an initial one-time funding. Within the first 30 days, you'll have close to $9,000 of that available. Then there's a premium that comes along with that. And let's just say you have anywhere from 50 to 60% of that available within the first 30 days. So I'm showing you at the end of year 1, but that ability to get at your cash value is accessible within the first 30 days. All right, so here we are at year 2. We took out a loan of 4,264. The loan interest is 298. This happens to be with a company where loan interest right now is 7%. Some companies are at 5%, but that's why you see 298. That's the yearly loan interest for that specific amount of loan. We didn't pay it. So that 298 gets added to the loan balance. So now we go into the end of year 2 with a loan balance of 4,562. And then in year 2, we have interest gets added to the loan. We have interest gets added to the loan. But what I'm showing is I didn't pay back any loans. I was not an honest banker. I'm just abusing the policy. I'm just showing you what it looks like. So at the end of year 10, if we have not paid any loans back, our available cash value is $44,395, which is $7,839 less than it would be if we would have paid this back. That doesn't mean the growth has changed, but I'm just saying if you didn't pay the policy loan back, it's going to reduce the available amount of cash value, and it's also going to reduce the available amount of death benefit we have. All right. Now let's say that we come along in year 5 and our loan balance is up to 5,224. So we're going to pay that at the beginning of year 5. But then I'm just going to point down here to year 10. Do you remember where we started? If I didn't take any loans at all, my cash value was 52,234 and my death benefit was 105,454. So this proves in this type of a company, and I'm going to explain this in a moment, in the right kind of company, your growth of your policy is not impacted by taking loans. That's what we call a non-direct recognition company. There are companies out there called direct recognition, which means when you take a loan, they will recognize that you took a loan and they will not give you the full amount of dividend crediting. This particular company that I'm showing here is a non-direct. Most of the companies we work with are non-direct, which means whether I take a loan or not, the policy is going to continue to grow. The dividends are going to be the same regardless of whether I've got a loan out or not. So just a little asterisk down here. If you have a company that is direct recognition, this math will be a little different. All right. So far we've just talked about product, right? We've just talked about the illustrations. We've talked about building an illustration, putting in monthly or annual or quarterly or semi-annual. We've talked about what happens if we don't pay our loans. We've talked about minimum premiums if we have, a job loss or, we're squished because the economy is, going down the hill and we have to pay more for eggs and gas and milk and those types of things. And Stephen, you can reiterate this too. I mean, what is our group really, really focused on? And anyone out there, if we've helped you solve your problems, just put in the chat solved. Maybe it's not completely solved, but you've helped. Someone on our team has helped you solve a problem.
Yeah, I mean, Craig, at the end of the day, I mean, a whole life insurance policy is, I mean, frankly, kind of boring. I mean, it's
Yep.
It doesn't do anything. I mean, it sits there. I mean, all the money within it's always growing and compounding. We can use it whenever we want. It's a nice safety net. It creates a legacy through the death benefit, if something does go wrong. But it's not fun, but what you can do with it is fun. And that's what you're talking about is, I mean, imagine paying off debt quicker than otherwise possible while still building wealth and creating a legacy for your family. I mean, why that alone? Like, if you have any debt at all, why would you not do that? And again, this isn't us just hypothetically talking and saying hypothetically, if you do this, you might be able to, like, as you can see that Craig put on the screen here, the left little part of this where it says debt blaster. Like, we'll design a policy for you, what's called an illustration. We take that, we put that into the debt blaster. We help you with the entire approval process. Once you're approved and you put that in force, as long as you're following the plan of doing exactly what you're doing already, it's guaranteed to work essentially. I mean, the only way it couldn't work is if you mess up and your discipline slacks, or maybe you lose a job and your financial situation changes. But even when that happens, guess what? We're right there with you, holding your hand. Our support doesn't stop once this policy goes in force. We have an entire implementation team, and our entire company talks about strategies all the time on how to help people years from now, next year, 5 years from now, 10 years from now. Remember, this is a whole life policy. Our goal, this is our legacy, what we're building here with BYOB. This company is going to be around for life. And so we're going to be there to help and support you throughout the years. And that's one of the cool things about it.
Yep. Absolutely. And the thing is, we are very hyper focused on using the process to solve the thing that you're trying to solve. And I see some questions in there about, hey, I've got debt, I've got no money. Sometimes it's just a matter of having that conversation and thinking about, are you overpaying debts? And could we take some of that overpayment, run through the policy first, and then throw it on top of your debts? Are there some things you could think about with maybe not max funding 401ks? There's just a lot of different things, and that's why a strategy call with our money mentors is recommended, just because we can talk about it and we might find out that here's a path you can go down and maybe you can implement this in 6 months, maybe not right now. But just having that conversation is what we're here to do. And behind that conversation is a problem that needs to be solved, whether we're putting it into our debt blaster tool, whether you're an investor and you want to see, hey, if I run money through the policy and I invest in a private lending deal, or I buy some real estate with that, that's what the gain projector is all about. You might be someone that says, hey, you know what? I've got a car purchase. I need to capitalize. I need to save some money for the next 2 or 3 years because my car is on the fringe and I need to buy a car in 3 years. So let's capitalize your policy and then use that to buy your next car. So anyway, those are just some of the things that we do. And so for all of you that said, I have debt, whether you can do infinite banking or not, please listen, because there's pieces of this that are going to help you regardless of whether you use infinite banking or not. And that's part of what the debt blaster will do is get you as efficient as you can. And then once we can do infinite banking, we can go to that third step. All right, so here's my fictitious guy, Bucky Doe, and he has 3 debts. He has a Chase Freedom card with $11,987 balance on it, which he's paying $299 a month for at 18.59% interest. He also has a Visa card where he's got a balance of $6,500. He's putting $162.50 a month towards that debt at a 22.56 interest rate. And then he's also got a used car. It's a Honda, $23,500, making monthly payments of $407.80 at 7.63%. Now, let me ask the group, everyone on today, how do most people pay debts? Which I mean, if I'm making payments to this Freedom Unlimited Chase card for $299 and I finally get that sucker paid off, what do most people do with this $299? Go ahead and put in the chat if yeah, Linda says blow it, Jody says spend it, spend it, spend it, spend it, spend it. Unfortunately, that's true. And what most people will do is they'll take this $299 and all of a sudden now I have a little bit of room to go out and buy some more stuff or maybe go out to eat more often. What we're talking about is we want to go to the next level of doing some sort of sequencing where we use that money to help start paying down the Visa card. And then when those two are gone, we'll go pay the Honda off. But let's just say this Bucky Doe is going to do what everybody else does, which they're going to just go spend that $299 when this card's paid off. They'll end up spending about $18,384 in just interest on $41,000 of debt. It's going to take them 75 months to get out of debt. All right. So that's just what the picture looks like. And that's with, making sure you make those payments consistently over and over. Now, Jody says snowball. I saw some other people saying, snowball and other strategies like that. The whole snowball idea is that you would sort all your debts by the lowest balance to the highest balance. And essentially what you would do is you'd pay off that lowest balance first, and then once that payment's free, you would use that to stack on to the next debt. And you just keep stacking those payments, and it would make the pay down faster because you're not blowing the money, you're using it to pay down your debts faster. Now, the question that is always out there, and I had a guy this week that asked me, hey, is the cash flow index more efficient? That's another way of sequencing debts, which looks at cash flow index is simply saying what is the balance in compared to the payment, and they're trying to come up with an efficiency of that debt and pay the least efficient debts off first. Snowball is lowest balance to highest balance. Avalanche is highest interest rates to lowest interest rate. Guess what? I don't care if the snowball, the avalanche, or the cash flow index is the most efficient, but just like you probably want to know which one is the most efficient. Can we agree that you would want to know what is the most efficient ordering of debts? Matthew's in. Yeah, absolutely. So that's one of the things a debt blaster will do is it'll look at all your debts and it'll figure out what's the most efficient order. So in this case, Bucky Doe's debts, avalanche was the best way to go. So I put the reason this one's in first is because it will pay off the fastest, just paying $299. So here's what we're going to do. We're going to pay that Chase card off in 63 months. Then we're going to take that $299 and we're going to add it to the $162. So Visa will be getting a check for $462.18, and we're going to do that in 67 months. Now we have two debts gone. Then we're going to take the $299 plus the $162 and the $407, and we're going to pay that Honda off with a payment of $869 every month until we get to that 70th month and it's all paid off. Now, doing it this way, we saved ourselves about 5 months. We saved a couple $100 in interest. And sometimes just looking at people's debt profile, I mean, you can cut time in half sometimes. I mean, it's significant amounts of time you can carve off if you just do this. So for everybody in debt, if you walk away from this presentation with nothing else, sit down with your debts, think about what's the most efficient order you could do, and most likely avalanche will be it. So order them in avalanche and just start picking them off and be disciplined to take that debt from, as soon as debt number one's gone, just keep stacking them and you will get out of debt faster. So the question is there another thing we can do in addition to that to help save, build, and protect and eliminate debt and create, legacy for our families? And that's what I want to talk about with the infinite banking. Okay, so here's how this works. You still have the Visa card, you still have the Chase card, you still have the Honda, and we have to make these payments of $162, $299, and $407. So it's about $869.98 a month. So we're still going to continue to pay the $869 to our debts. Because what's going to happen if we don't send the dealership our $407.80 for a Honda Accord? What's going to happen? What happens if we don't make our car payment? Yep, repo man shows up and he takes our car away. So
I'll tell you, Craig. I'll tell you. My dad owned a buy here, pay here dealership when I was a kid in high school, and we had a repo guy, and that was one of the wildest guys I've ever heard. I talked to in my life. The stories of him going and sneaking in people's houses at midnight, hook up their trucks and pull them away in their cars, and just wild times, man. You do not want that to happen to you. So be your own bank so that never happens to you, just in case. Go ahead.
Yeah, I bet. I don't know if did you ever get to do any rides with him to go do some repos?
No, I can never get a bulletproof vest. I'm not going in that thing without a bulletproof vest. I'll tell you that much. Oh,
Yeah.
thank you.
Yeah, so that would be a pretty exciting job if you're a repo guy, but unfortunately for the person that has to get to work tomorrow, their car's gone. They
Oh,
didn't make their payment, their
horrible.
car's gone.
Horrible.
So, the point here is like, who is in control at this point? You are not in control. You need to make those payments, otherwise there's going to be consequences, but that 869 needs to continue. Now, for those that that have some savings or they want to, they have some money that we can run through the policy, I'm using the same $500 a month policy that we already covered in the previous examples. So there's two things going on here, and I really want to stress this. There's two things going on here. 500 is going into the specially designed whole life policy every month, $500. And every month we have to continue to service our debt of 869.98. Those two things are going to continue to happen. However, we're now going to, let's say every month or every quarter, we're going to take the maximum loan from the policy because we're putting in 500 every month. That's going to mean we have some resources to pull out as a loan and throw on top of the Visa card until that's gone. Then we're going to just keep doing this process where the 500 goes in the policy every quarter, take the money out, throw it at the debts. If you do that and you stay consistent with it, instead of 75 months, all of the third-party debts are now gone in 41 months because we're putting our savings to work on top of those debts while they continue to grow in the policy. Our total interest paid to Visa, Chase, Honda, is now, and to the insurance company, because we have some loan cost inside here, went from 18,000 to 9,000. So we cut this down quite a bit. So just with this process of running money through the policy, taking the loans, putting it onto our debts, we will pay off our debts even faster while we have our savings still growing and compounding. Now, can I do this with a savings account? I can put 500 into a savings account, a high yield savings account, but as soon as I pull that 500 out, I'm no longer compounding or earning money on it. That's one of the biggest differences of why we use the whole life policy, is because when I put that 500 in, it's going to continue growing even when I leverage. So that's the beautiful thing about this. And there's a lot of other benefits, but just thinking of this as a savings account, 500 is going in, it's going to be a magical savings account where it keeps compounding and growing while we leverage. That's all we're doing here, folks. It's actually a pretty simple process, but there's some dealing, some things we have to do to set this up properly. Now, what happens after Visa, Chase, Honda, they're all paid off? What happens? Well, we no longer take that 867 and keep paying those debts because they're paid off. What we do is we make that back to policy loan repayments. All right, so what does our monthly cash flow look like? Well, 500 is going into the policy in our savings, and now 869 is going back into our policy loan because we want to be able to repay that. And I'm going to show you an example of how the loan operation works. But at this point, it's just pretty simple. We take that arrow that was going to the third-party debts and we just pay back our policy loans. Now, let me ask you a question. If you have a bad month and you need to go down to your minimum payment here, which I think before we were talking, it was 100 and let's call it 150. You were paying $407 of car payment, but let's just say you can't do it this month. If you don't make this policy loan repayment, who's coming to get your car? Does anyone know who's coming to get your car? Nobody. So who's in control here? You're in control. And not that we want you to not pay that loan back, but if, look, life happens, things come up. Let's say something happens with a car and that 407 needs to go to, a transmission repair or whatever it might be. You don't have to pay the policy loan back on
Hey,
a
but Craig, wouldn't the insurance company send a repo guy?
No, they're not going to send a repo guy. But why are they not going to send a repo guy? What do they have as collateral in this policy? Does anyone know what is the collateral for that loan? The policy, your life, the cash value, death benefit. Yeah, so I kind of jokingly say this, but it's true. The life insurance companies did a study of 1,000 people born, 1,000 people will die. They know at some point you are going to die, or we sometimes call it graduate. So if you have a policy loan and you were to pass away, they're simply going to remove from your death benefit whatever loan was outstanding, and the rest goes to your family. So that's why they're not going to come out with the repo guy. Steven's not going to be riding with the insurance company to come and get your car. They don't care because they have your death benefit and they know that that will pay them in whole at some point in the future. Now, there's a few other details I want to cover here. We talked about how those third-party debts are gone in 41 months, but a lot of people say, hey, Craig, I know I've got a policy loan, but how long is it going to take me to pay that back? Well, 21 months is how long it will take to pay the policy loan back at $869 a month. So guess what? You are done. You are completely done with your third-party debts and your policy loan repayment at month 62. If you remember from the previous examples, it still took us 70 months just to do the avalanche. We weren't leveraging savings to be, transparent, but it's still 62 months. We've accelerated our debt payments. Here's what I get excited about is now at the month 62, you're going to have approximately $29,146 of cash value that can be used to do what? What could you do with this, $29,000? Anyone have any ideas? What could we do with this? Invest. I love it. Buy another car, invest. Absolutely. It's the infinite banking concept. So you can do whatever you want with it. It could be money that you use to launch an investment, it could be used money to start a new business. It could be money to buy your next car. You guys are on it. You guys are really understanding. So yeah, it's now just resource that you can use for the next thing, and you still have about $150,000 of death benefit at that point. So how do we do this for you? So if you have debts, you're not sure if this will work for you. Stephen, you can put into the chat how people can reach out to our team, but having a conversation with our team about and come to them with your debts. So we want to know your debt balances. We want to know your interest rates, your minimum payments, your monthly payments. And if you're one of those people that have the 0% cards and in 6 months it's going to go to 28%, give us that information as well. We can have a conversation about your cash flow. We can have a conversation about, where's your money going? Do you have any savings? And maybe at the end of that conversation, we'll say, you're not ready for infinite banking, or maybe you are. But if you do these 2 or 3 things, you can continue to reduce your debts and then come back and talk to us and we can start the policy. So anyway, that's what is available to you. If you want to take it, we're here to help. That would be the next step, I would say, for you. Now, we're going to go through one more exercise and then we'll have just some Q&A time. Does anybody know why I have a picture of ants stealing peas in the context of being an honest banker? Nope. Some people say no. PC Juds, nope. I know there's some people out there that know why there's a picture of ants stealing peas. All right. Don't steal from your own bank. Absolutely. Ants hold 10% more of their weight. I love that, Ryan. So in the book, Becoming Your Own Banker, and I've always got it on my desk here. This book was written by R. Nelson Nash. He's the one that kind of codified this whole process. He talks about a grocery store. If you owned a grocery store and you went into the back of the grocery store and you filled up your shopping cart with all the food and then you went out the back door without paying it, would you be stealing from your own grocery store? And so he was trying to say, don't steal the peas. Don't go into your own grocery store, take a can of peas off the shelf and go out the back door because you're stealing the peas. The principle there is don't build your own banking systems and then be a bank robber where you take loans and you never pay them back. So that's the whole concept. Don't steal the peas. That's where it comes from. If you read the book, then you'll get more details on that example. Here, the next thing we're going to go through is loan operations. And so there's a little bit of math in here, but at the end of the day, what I really want you to walk away with is, what is the benefit of being an honest banker? Why would I want to pay my loans back? So here we are. The first thing is with these life insurance policies, the loans are a simple interest. So think about your home mortgage. Let's say you just got a brand new home mortgage. It's at 3%. You finance 350,000, and let's just say your payment's 2,000. I'm just pulling numbers out of the air because I don't know what the numbers are off the top of my head here, but let's say you have a $350,000 mortgage or balance, and you're paying $2,000 a month. How much of that $2,000 a month let's say in the first year, is going towards interest versus principal? Has anyone ever looked at their mortgage statements? Yeah, Jody says most of it. Depending on the interest rate, I mean, it could be 70 to 80% of your payment is going to the bank's interest pocket. Okay, so when we talk about simple interest, it's a completely different game. And Joe on our team, if you've ever talked to Joe, he calls the traditional mortgages, he calls it the devil's arithmetic. So I love how he puts it. But let's say if you have a policy loan for $10,000, so that's what, this 10,000 represents. We're taking a loan for $10,000. And let's just assume the interest rate on this is 5.24%. Okay. Some companies are at 7, Lafayette's at 7, some are at 5, they're kind of all over the place. All right. So $10,000 loan at 5.24%. What they do is they say, okay, this month, what is your interest charge? Well, it's $44. Next month, we still have a $10,000 principal balance because we're not paying anything back. So now our cumulative interest is $87, then it's $131. So you see what's going on here. If I have a 5.24% interest rate, I'm going to pay $524 of interest at the end of the year. That's how much interest I'm going to accumulate. So nothing magical going on here. A $10,000 balance, 5.24% interest rate. I owe $524 at the end of the month. Or I'm sorry, at the end of the year. Now, what they'll do is if I don't pay this, they'll just say, okay, going into year 2, my principal balance will be $10,524. All right. Now let's see what happens if we're an honest banker. Now we're putting $500 a month into our loan repayment. And you'll see over here in the principal balance, if I put in $500 into my loan repayment, my principal balance went down by $500. So unlike our home mortgage, when we put $500 into our home mortgage, the principal balance probably goes down 22 cents. I'm just making up a number, but it goes down very little. In a simple interest, all of our payment is buying down the principal. So now we have a $9,500 principal balance. Next month it's 9, then it's 85, then it's 8. Do you see what's happening here? We're buying down the principal and we're buying down the interest. So I'm just showing you in this red box, this is the interest that would have been accumulated if we didn't make any payments. So let's go all the way to the bottom. Because I made payments back to my own banking system, my interest charge is now $354 versus $524. We made $6,000 of principal repayment. Okay. What happens to the principal that we repay? When I make a $500 principal payment, it goes back to increase our cash value that's available. So if my available cash value was 10,000, well, now my available cash value is 10,500. Next month, it goes up another 500, then another 500. So this money is still accessible to me. It's not like it's a bill that I'm paying and it's going away. It's just the principal is going back into my account. However, this 354 goes to the insurance company. Okay. So if that's the case, what is the actual interest charge in this specific situation? Can anyone tell me what is the interest that we pay? What is the interest rate we paid? Is it 5.24? It's 3.54. So our real interest rate that we paid is 3.54 because of the simple interest loan, I only accumulated $354. So wouldn't it be true that if I'm an honest banker and I'm looking at not paying the loan versus paying the loan, didn't I save about $170 of interest that would have gone to the insurance company? That's the benefit of being an honest banker. What if we pay $833 a month? Is the interest really 5.24 or is it 2.4%? Because now my interest charge is $240 for the year. So this is the benefit of being an honest banker. If I borrow from my policy to buy a car, I want to pay the same amount of interest or the same amount of payments back to my system. And there are some other things that get involved with that, but we can always lead you through that. But the whole point here is when I'm paying back my banking system, just like I would a car dealer, I'm going to save an interest. So I'm not really paying 5.24, I'm paying 2.4. There's something else going on behind the scenes, which is that uninterrupted compound growth. So while I'm doing this and I'm paying this $240 of interest, my policy is still growing and compounding as if I never used it. So that's really the benefit. That's really all that I wanted to cover today. So I know we've still got some time. So I'm open to some Q&A here. If you guys want to jump back in, I can go back in any one of these parts of the presentation and just talk about more specifics. but let me know.
Yeah, guys, if you put your questions over in the Q&A, we can answer those and clarify some things for you. I'll put the link one more time to schedule a call. We have a handful of money mentors that we work very closely with. This is all they do full time is talk with our clients, design the proper policies depending on your situation, strategize with our clients. They're all Nelson Nash certified IBC practitioners and have a lot of experience with this. And so get a call scheduled with them to talk about your personal situations. But we're happy to answer any questions on here. The one thing, Craig, we didn't really get too much into yet was, different ways to kind of use this for investing. And I just want to throw out some things that we're doing right now. We started a platform called Private Money Club that provides a place for real estate investors to meet people that have money and are looking for deals. And that's a lot of what Craig and I and a lot of people on our team are doing right now is finding opportunities and deals on Private Money Club and doing direct money lending, with money from our policies. So it's another great strategy. The other thing that I did want to mention also, Craig, real fast is the money that's going into these policies. We talked about some different sources of where the money comes from and things like that, but just keep in mind, it's what we call non-qualified funds that are going into these. So these are not qualified products, meaning it's not an IRA, it's not a 401k, it's not any kind of qualified funds. And so we want to kind of keep those separate. We want to make sure that the money flowing into these policies is like cash, it's non-qualified money. But if we want to also control our retirement dollars, that's where we turn to look at something called a self-directed IRA. So if you have an old 401k or a financial advisor, an IRA with, Charles Schwab or something of that nature, you can actually take and control that money, that IRA, those retirement dollars, those qualified funds, and you can self-direct those into various investments, into businesses, into real estate, things of that nature. So as you start to take control of your money, control of the equity in your homes, control of everything, you really want to be smart and make sure you're controlling all of it and not just some of it as well. So just know there's different layers to this, different levels, and we can go as deep as you guys want. But yeah, let's answer some questions, Craig, and kind of go from there with it.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
Sure. Yeah, I see one. I'm just kind of looking over the screen. Anonymous asked, how do we set up a loan repayment? So there's a couple things going on. If you have a policy and it's on a monthly premium, the insurance company will automatically draft that from your account. So that's the premium side. Now, they don't require any sort of structured loan repayment, but if you want, you can go in and manually pay every month. You can set up a bill pay or a direct deposit. So you can schedule that if you want to. So just know on the monthly premiums, those are oftentimes getting auto drafted from your account. And then on the loan repayment, you would just set up, either a loan repayment on your insurance company's portal, or you would just go in and hit the pay button. So there's a few different options, and it just depends on how you want to do it. And I saw some other questions about, James says, is it more advantageous to just pay the interest on the loan for the year or keep using the loan principal for making more and more money with investments? And, James, that's a really good question, because when we talk about investing, say with Private Money Club, we can run the models to show where you're taking the maximum out of the policy and keeping the money out working and using some of that gain just to pay the policy loan interest. So we can run that model. That's one way to do it. Now you're going to, depending on your situation, what I like to do personally is I like to have a little bit of dry powder in my policies. I like to have some cash value in there for a rainy day. Now, if that pile of money is not, you've got that dealt with somewhere else, perfect. Then just keep leveraging, the policy. So to that point, I think we got that one answered.
I can just read down through. I have a policy with Foresters I don't feel comfortable with, debating if I should cancel it, take a loss, call it a day. Glad I'm better educated now. It just depends. Anonymously, something we can do is we can look at that for you. If you get what's called an in-force illustration, schedule a call with us. We can take a look at it. We typically don't love exchanging a whole life policy because depending on how long you've had it and things of that nature, but we can look at it and give you some recommendations or feedback. But if you have like, those of you that have policies, let's say it's an old IUL or a VUL, something from the past, and we're worried that thing's not going to perform, especially the markets. The markets are skyrocketing right now, which we'll talk about in a second. But anyways, if you have something like that, you can do what's called a 1035 exchange, which is very similar to real estate. It's known as a 1031 exchange. But basically, with a 1035 exchange, you're taking the cash value from one policy and just moving it into the new policy. And it's a great way to jumpstart the new policy. Most of that 1035 money doesn't really count against the MEC. So you can still load that thing up with dump in and premium and get it over into a better vehicle. So in certain circumstances, we can do that with you. It just depends, but we'll look at it for you and kind of give you some feedbacks and pros and cons. And keep in mind, that's what we're going to do in all of these situations. We're going to give you guys options. We're going to say, hey, listen, we can design it this way, or we can design it this way. Here's the pros and cons here. Here's the pros and cons there. Or, hey, I had a couple people asking like, hey, should I set up, a policy for me and one for my husband or wife, one for me and then two of my kids, or just put one big one on me? Like, we could talk through these situations because they are very unique. Every single policy that we design is unique and different. So just like snowflakes, how not one are ever the same, exact same thing with life insurance. Never ever is one policy exactly the same. And so again, this is all we do all day, every day. So we'll give you options and talk it through with you and let you decide what the best route is for you and your family. Warren said, can you set it up automatically, pay the interest by using the dividends so you don't have to pay it yourself?
Yes. So the dividends can actually be used in different modes. You can use it. The way we set it up is just think of it as reinvesting into the policy, and that's going to get you the best growth mode. You can use those dividends to pay policy loans. You can use the dividends to pay premiums in the future. So I think there was a question I saw through the chat, and it's gone. I can't find it again, but someone had asked, how long are you paying premiums? And when you see what's going on mathematically with the policy, like all my older policies, I'm going to pay them until I can't. But you can use dividends to cover part of the premiums in the early years, or you can use the dividends in the later years because they'll be big enough where they can just pay the base portion of the policy. So dividends are flexible. You can use them for loans, you can use them for premiums, you can use them to kind of reinvest back into the policy. And that's the default of how we set those up. How do we set up loan payments? We did that one.
Hey, Craig, I had a couple people asking about Private Money Club as well. So yeah, you can go to privatemoneyclub.com, check that out. I'll post a link. I also have a team, a PMC success team that they'll do a blueprint call with you and talk you through, what real estate investing looks like, what private money lending looks like, and what PMC can do for you. So I'll post that.
Yeah, and if Stephen, if you want, I can just jump into PMC and just show kind of what that looks like real quick.
Yeah,
If people want to see it, yeah, let's just share that out.
And while you're pulling that up, guys, Private Money Club, again, it's a community of real estate borrowers, real estate lenders. So people that have money, maybe you've taken money out of the stock market, maybe you are sitting in some cash. Well, you can go on PMC, and as you can see on the screen, you can find deals. So these are other PMC members that have investment deals, and they're looking for private money. So there's a million reasons we talk about it on the different PMC webinars, why investors use private money over bank money. But basically, this is done all day, every day. Millions of dollars flow through PMC through these private loans. PMC is simply a platform to provide the education tools and area for people to meet. We don't get involved in the deals. It's between the borrower and the lender directly, just like a bank does, using a mortgage or a deed of trust, using a promissory note, using proper documents, closing attorneys, escrow, and everything else. So we're lending money the exact same way that a bank lends you money on a 30-year mortgage. We're lending the money the exact same way to investors, although it's instead of a 30-year amortized loan, it's typically a 6 to 12 month interest only loan. But regardless, you'll see great deals on there, 10, 12, 15, 18% returns. This one's offered by Noah and Christy, who are very experienced and very well-known investors within PMC. They have a 100% track record going on almost a decade now. So they're able to borrow money at 10%. because you're always going to see risk versus return on these deals. The higher the risk, the higher the return, the less the risk, the less return. So 10% is kind of at the bottom side, because with Noah and Christie, a lot of people look at them like a risk-free loan. Of course, there's risk in everything, but as close as you can get there. So just to give you an example there of why you see 10% on that deal versus maybe like 20% on that Jason Matthews deal. Now, I do know Jason as well, incredible guy, but the nature of new construction typically brings on a little bit more risk. So you're going to see a little bit higher return right there. So these are things we talk about and educate through PMC, but it's an incredible community. We have a live in-person event coming up May 8th and 9th in Dallas, Texas. So if you'd like to come out and meet myself, Chris Naugle, Craig, I know you'll be there. Sean, a few of our other money mentors, as well as about 20 other experts and about 100 members are going to be at the PMC Money Tank event. So that's Thursday, May 8th and 9th. We have very limited VIP tickets. I always say go VIP, but very limited VIP tickets. We have plenty of general admission tickets left. So get your tickets if you want to meet us in person, spend a couple days together. We got dinners planned for all 3 nights that will be there. We have a full schedule set up for the 2 days, and it's going to be an incredible event. So really looking forward to that. And if you're new to private money lending, we do offer a coaching class. It's an 8-week hand-holding coaching program to teach you literally everything you would need to know on how to get started with private lending the safe and right way. So we have those resources available through PMC, but it's a great platform.
All right. Go back to the question queue here.
Cool. Tito said, I thought when we borrow from our policy, we're borrowing the insurance company's money while our cash value grows.
That's correct. And what you might be seeing is when we took a loan, the available cash value decreases. So let's just say you've got $100,000 of cash value available in your policy and you take a $10,000 loan. The $10,000 loan is coming from the life insurance general fund. So it's not coming out of your policy, but they're using your death benefit as collateral. The cash value is just a ledger statement showing how much do you have available still. And so 100,000 was my full amount. I took 10,000. So now my available is 90. If I pay that 10 back, it goes back up to 100. So you're correct that it is the insurance company's money. It comes from their general fund. And if you actually go out to the annual reports of any of the insurance companies and you look at their premium dollars, which is what they're investing, it goes into bonds, mortgages, you'll see in their policy loans. And those are policy loans from all their mutual policy holders. So it does come from the general fund. How easy or hard is it to withdraw and pay your loan like a bank? How many days does it take to withdraw? So if you have money that's been seasoned in the policy, let's say that I've been capitalizing and putting, $500 a month in, $500 a month in, and in 6 months, I want to take the money out. Because it's been in there and it's been processed, it takes about 3 to 5 business days to get the money out. Now, if I put money in today in my policy, we always say within 30 days of doing that deposit, that's when you'll have access to it, because it takes time for the insurance company to take it from your account, put it into their system, credit your account. So just plan on any new money is 30 days, any seasoned money, 3 to 5 days.
They said explain MEC rules. So MEC is modified endowment contract. These are rules that are set by the IRS that govern whole life contracts. And basically they came about because back in like the 70s, the oil tycoons were really utilizing whole life policies. They were dumping billions of dollars into these things and taking full advantage. And the IRS was like, whoa, 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 we got to set some limits. So basically the limits say there needs to be a certain amount of death benefit that supports the amount of premium and cash value within that policy. So when we design these things, we basically design them right to that MEC limit, which gives you the highest and best use for banking purposes that you're going to get from a whole life policy. So we build it up to that MEC limit. And then once you're ready to go beyond the MEC limit, that's when you would start opening up additional policies. So, I mean, how many policies do you have, Craig, now?
In the family, there's 5, and I need to do 3 more like real soon.
Yeah, I mean, so you just keep adding policies as you grow your banking system, since you can't, add more to the existing policies because of those MEC limits. You just start opening more policies. And as long as you can financially and physically qualify, you can have as many policies as you want.
There's a question, is there an age where buying life insurance is not profitable? So is there an age where maybe it doesn't work as well? when you get to around 75, that's where some of the riders that we need are no longer available. But a lot of that up to that point is going to depend on your health, your income, so there's different factors. But so I would say in order to get a proper answer, you may just want to schedule a call. But if we do get to that 75 age, that's where it becomes challenging because we don't have the ingredients in the policy that we need to be able to make it work for infinite banking. Is it protected?
Yes.
So each state has different rules around how much is protected. Like Texas, for example, they will protect 100% of the cash value. So you kind of need to look at it on a state by state basis. Colorado, where I live, not good. I think they only protect up to 250,000, but each state is going to have some different rules around that.
Yeah, Florida is very protected. It's one of the reasons that O.J. Simpson actually lived here because his majority of his wealth was in life insurance and various vehicles that are protected in the state of Florida from lawsuits. So it's one of the reasons he lived down here before he passed.
Will Smith is asking about the whole loan payback process. So if he's saying if I do a deal that pays out a lump sum at say a year's end and I take a loan for my policy, the interest is accumulating. So if you just pay the loan interest at the end of the year, will it be the full amount? Yes, it would be the full amount. The way to reduce that would be to make regular principal payments throughout the year to buy that interest down. But that is correct.
Yeah. So yes, this is infinite banking. Someone said the last time I had a team member call, they offered an IUL. You talk to somebody that is not doing this for the right reasons. We would never ever use an IUL. It's not a good vehicle and product for infinite banking. I personally don't think an IUL should ever be used. Maybe there's a scenario for ultra wealthy using premium finance for long-term planning, but for most people, I would stay completely away from that and never use an IUL for infinite banking. So that was definitely not anybody you talked to at Money Multiplier, BYOB Money School, Anonymous, but it's a good thing you walked away from that, it sounds like. So good job. Patrick, are these weekly meetings recorded? Yep, I'll put it in the YouTube link so you can watch it. We usually put the recording a couple days later on YouTube channel. Don said, how can we be sure that our interest charge is paid directly to be interest so it doesn't keep accruing?
So at the end of Don, at the end of your policy anniversary, when say your premium, say you're on annual, when your annual premium's ready to be made, they will say, oh, your interest charge is X. Do you want to pay it? And that's when you would pay your interest charges at your policy anniversary. If you're making payments throughout the year, which sometimes I'll just set it up where just come up with a payment schedule and just pay that every month and don't worry about paying the interest at the end of the year, just let it roll. Then you're paying principal, not interest. But if you have some questions, we can go through that. If you have an implementation specialist, we can help you there, or feel free to reach out to me if you have a question. I can kind of help you with that piece.
Yeah, real fast, Ryan. You start the policy in the state that you live in. That's all you're able to do. They'll start a policy where your resident state is. There's no advantage or disadvantage to start them in other states. It's where you live, I guess, for protection reasons, but you'd have to change where you live. So, and Andrea, the amount you start with is completely up to you. We recommend as a minimum, as a guideline minimum, to start with 10 times your age on a monthly basis. So if you're 47 years old, $470 a month. If you're 32 years old, $320 a month. So that amount or more is what you'd be looking at wanting to put into this thing. And keep in mind that is flexible. So if financial things, happen in the future, you aren't able to put that in, we could always lower it down a little bit so you can continue putting in a smaller amount and keep the policy going. So there's some flexibility there for sure.
What are the negatives of this type of banking? Can you lose it all? And I mean, I think the negative is not doing it. I mean, I hate to sound cliche-ish, but the negative is not getting started, not doing it. But can you abuse your own banking system? Can you blow it up by doing things where you weren't treating it properly? You can. So let's say, for example, you fund it, you take the maximum loans out, you quit paying premiums, you just take all the money out as far as loans. I've seen some people do this, and the policy will lapse. So there are ways that you could purposely blow this up. But if you're doing the process as we teach it, you're following the guidance that we give you, then it's I mean, you've got the guarantees, you've got the guaranteed growth. It's really hard to break it unless you try hard. Susan says, I have two 5-acre pieces of land. I'll have 113K from a separate HELOC. I want to build to create passive income. Can you help me build, or can your investors invest to build permits? How do I invest to build wealth? So I don't know within Private Money Club if you have some ideas of how you want to answer that for Susan.
Yeah, I mean, Susan, you got a lot of different options there. First off, anytime you invest in something, you want to know, like, and understand what you're investing in. So maybe check out Private Money Club, maybe one of the coaching programs, maybe you become a premier member and get certified. You just create a group, you can look for partnerships, maybe JV. There's a lot of things you can do right online that way on the platform. If you're really serious, I'd highly recommend coming to Dallas and meeting people in person. Form relationships, find somebody that wants to teach you how to do that, maybe partner with you, depending on exactly what you're trying to accomplish with it. But it's always going to boil down to relationships and people working together. And so that's what PMC is all about. That's what our community is all about. And so you're in the right place. It's just a matter of finding the right people to work with you with it all.
Robert is asking about the second time for the, what time schedule is the second free PMC meeting?
I'll put the link for all of our weekly meetings over in the chat box right here. So webinars, you can register for these. They're either Zoom or live streams, but it'll tell you where they are right there.
Adrian says, is it better if I pay monthly? So really is it better if it works for your cash flow and monthly is what you can do, then that's better. As we kind of went through in the earlier slides, if you can do annual, there's mathematical benefits to doing that. But if that doesn't work for you, then of course it's not the best. Sean says, I would save my annual deposit in an interest-bearing savings account, then transfer that money into my BYOB account once a year instead of quarterly, monthly, or deposits. Absolutely, that's a great strategy. So if you can do your initial annual and then do what Sean's talking about, is be purposeful and set that, just come up with a monthly payment that you put into, say, a high yield savings account. The insurance companies also have what's called a premium deposit account where you can store it in there too, but you're going to do a little better with a high yield account if you do that in this day and time. So Sean's got it. That is correct. How many policies can be utilized per Social Security number? What's the max ability to fund load? So a lot of that, Jay, is going to come down to your human life value. And the insurance companies look at everything on a human life value, which means, let's say I'm 30 years old and I make $100,000 a year. They're going to say life insurance is income replacement. So I need to be able to come up, let's say I die today, my family would need at least 100,000 for the next 30 years. So they're going to say my human life value is 3 million. So that's just kind of a rough number. So if you take your gross income, there's a multiplier on that, and then they'll come up with your human life value. But that's essentially what's going to be the cap of what you can do. And then there's a premium to income ratio. So if you're making 100,000, they may only allow you to put up to 20,000 a year in premium. And they're doing that just because they want to make this sustainable. They don't want you to say, hey, I make 100,000 and I'm going to put in 90,000. They just know that's not going to work long term. But those are things that we can sort out on strategy calls as well with you. What is the floor and ceiling on the interest for the last 10 to 20 years? I've been doing this for 15 years personally, and up until probably 2 years ago, my interest rate on the policy loans was 5% every year for the last, probably almost 15 years. The last couple of years, we've seen that creep up a little bit, but there's something else that happens when interest rates go up. When interest rates in the economy go up, yeah, the loan interest rates on the policies can go up, but guess what else goes up? The dividends typically follow as a lagging indicator. So I can't guarantee that, but this is just what has happened in history is as there's higher interest rates in the market, the insurance companies go out and buy long-term treasuries. They make more money on the bonds. They can share more out in dividends. So typically, as we see everything shifting up, dividends shift up, interest rates on the policy loans shift up. So they kind of match, they kind of track with each other. How do you know if the request to lend hasn't been lended already? So I'm guessing Anna's asking about in Private Money Club, if there's a deal up there, and just like we were looking at Noah's deal and some others, if the deal's up there, it should still be active, but let's just say that Noah's asking for 145,000 and you have 50. You could reach out to Noah and say, hey, Noah, I've got 50. Would you be willing to, split this across a couple of different people? So don't be afraid to go out and be a deal maker. But generally speaking, you will want to reach out to these people. You will want to get their financials. You will want to meet with them. You will want to talk with them. So in doing that, you're going to find out if they still need the money for the deal.
And when a deal gets fulfilled, they have the money, they'll remove the deal. They on the deal page, they click a little button called funded, and it removes it from the site.
Yeah. And then Anna's got a couple other follow-ups. Who sets the percentage on the private money club deal? Like how much?
Negotiation, the borrower is going to ask for something, and then you as the lender, you guys can negotiate the terms of that deal.
Yeah. George is asking, can you invest in paper in private money club, discounted mortgages?
Yes. Yep. Several note investors and offers on there. Yes.
Let's see. Chris is asking, PMC as it was being upgraded had the money to loan or project training free. What happened to that? I went in to start this. Well, and there's a large price tag for both, but I only need the loan section for now.
I'm not sure exactly, Chris. Maybe shoot me an email, a little more details, and I can clarify for you. I just know we're getting down to the end here, Craig.
Yep.
Trying to knock these
Let's
out.
see. Can you do the 7 premium without the MEC with the IRS? Really, a lot of that's going to come down to policy design. And do you have to pay premiums longer than 7 years? The MEC is going to be there when we have to deal with that. We have to design around that MEC. So that's something we're going to have to design into the policy. Avery's asking where to find the MEC rules. You can Google it. Google modified endowment contract, and you'll find all sorts of good information about it.
Yeah, but remember, we do all that work though. Like we
Yep.
design the policy, we're going to make sure that it's done right. So no worries there.
Yeah, and Robert's asking how much cash value is protected in California. I don't know off the top of my head, but if you look at your state commissioner site, they typically have things posted in terms of what they protect against judgments and
Probably
creditors.
not much in California. California is not the best state law-wise to live in.
Don wants to know, do they send you a separate bill for the interest? Typically, that's just on your billing statement. They'll show you your interest, they'll show you your premiums. And some of it's going to depend on what company you're using. If it's Lafayette, One America, Mass, they'll do it a little bit differently. Is it true that compound interest grows faster if I pay my dues yearly than paying monthly? So Kurt, yes, when you put the full amount in at the day one of the policy, the full amount's there to compound and grow. So you're going to see a little bit of a benefit. And that's what I was showing earlier in the presentation between the annual, the semi-annual, quarterly, monthly. So there's 2 things there. There's one, you've got all the money in the policies, so it's compounding more earlier. And when you go off a non-annual, there's a little charge that the insurance companies will charge for monthly, quarterly, or semi-annual. So all of those things are at work. Can I transfer all of my Social Security benefits into this in case the Social Security system goes bankrupt? Unfortunately not. So if once you get the Social Security payment, let's say you get a check from Social Security, well, then you can do whatever you want with it. You could put it into a whole life policy, but you can't go and say, hey, the government owes me $10,000 and I want it now. So I don't think that's going to work, but I wish you could. That'd be really cool. I'm in the money club. When I invest with someone, do I make money on a monthly basis? Is it yearly that they offer? I'm concerned if I'd rather make it monthly. Can I find investments pay monthly? Absolutely. Most of them that I deal with, Kurt, and pretty much all of them I deal with, I get monthly interest checks. There are some that have deals where they'll pay you out quarterly or yearly, but I like the monthly cash flow. What are the taxes for loans from the policy? If there is not a MEC involved, which that's the way we set them up, there are no taxes on loans. There's no taxes on growth. And the death benefit is also tax-free.
The long-term care you're going to want to do is a separate policy. We can set that up for you. We have one of our mentors that specializes in long-term care, Mike Samet. So if you want to shoot me an email, Tito, I'll connect you with Mike. And the reason I say that, Craig, just to clarify, long-term care can have cost involved. And when we build these infinite banking policies, we really want there to be as low cost as possible. So it's more efficient for banking purposes. And so you do have some free riders and some free benefits and things like that included in this whole life contract. But for a true long-term care policy, you're going to want to do that separately. It makes all the sense in the world. And those are really, really, really good policies, especially through One America. It's one of the best providers of long-term care in the country. So we can go through that with you for sure.
Kurt's asking how he can get his wife on board. And sometimes that's just a challenge. I mean, it's I would say have her join the strategy call with, when you're doing those and just have her part of it. There's a lot of resources. Some of them get a little, like if you're talking to me, I'm very technical and I can show you all the numbers, but then there's some people that are very good with the mindset of the whole thing too. So some of it might be just trying to find the right content that she needs to help her. But hey, it took me a year when I first heard about this before I did anything. So I'm not going to say the first time I heard it, but I got it and ran with it. George is asking, are we protected from bank bail-ins in the insurance policy? So banks and insurance companies operate on a completely different level. Insurance companies are regulated at the state with the state commissioners. They're required to have reserves for the death benefit. So they're very cash heavy. If a mutual insurance company ever failed, the state commissioner would take them over, and then there would be most likely some other company buying that book of business. So it's completely different than a bank, and I feel safer having my money in my policies than I would in a bank for that reason.
That was good. And just so everybody knows, we do another full hour of Ask Me Anything happy hour at 4:30 Eastern. So if you guys go to that YouTube channel I keep talking about, at the Chris Naugle, put in the chat one more time, subscribe. You can watch us live right on the YouTube channel, type in all your questions. And not only Craig and I, but the rest of our team will be on that stream answering your questions. So you can hear different mentors' opinions. You can meet some of the mentors that you're going to be working with to start your policies. So one more time, if you haven't already, schedule a call now with our team. I'll put the link over there right now. Schedule that call, get on the schedule, get your policy started. For those of you interested in private money lending and what Private Money Club has to offer, or if you're looking to go to the Private Money Club Dallas event, I'll put the link over there to schedule a call with those guys. And anything else that you might need, just send me an email, snaggy@chrisnaugle.com or at privatemoneyclub.com or at whatever email address you have for me.com, because I have a bunch of them. But yeah, shoot me an email if you guys need anything at all. Craig and I are here to help. Craig's ready to build tools. Craig's ready to build designs. Craig's ready to take you to the next level as well. So we appreciate everybody being on here today. But any closing comments here, Craig?
No, I just appreciate everyone's involvement and sticking around. We went a little bit over, but as Stephen mentioned, we've got a group of mentors that can help you. Reach out to Stephen or I if you have specific questions, but we're here to help you solve your problem, and really appreciate you being here and participating in the conversation today.
Yep. All right. Good stuff, guys. We'll appreciate everybody. Have a great week, and we'll see you guys on the next show. Thank you.
All right. See y'all.
All right. So I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.